It's official. Credit Suisse is being acquired, but what does this mean for potential recession? And what are charts telling us? That's probably the bigger issue. Let's look at exactly that. So first things first, financial conditions as of this morning here on Monday, nice and tight. We want these to remain tight. The tighter these remain, the less the Fed has to do because the market does it for them. This is what you want. This is a combination of not only bond yields, lending tightness, what's going on in stocks, but other financial assets as well. It is the Goldman Sachs Financial Conditions Index. Compare that to the 5-year break-even, which is also very important because we do not want to go back to unanchored inflation expectations. So what do we have here? Stable drop over here. Last we checked, we had just fallen, and now we're holding stable down here. You can see we're almost at the same levels where we were right before January. Well, let's see here. I guess this was within January. This was about the second to third week in January right here. Here's your January window. There's your Feb. Here's your March. There we go. So right before we started getting that hot January data, we actually hit a pretty low level here. Now, where we sit now, where we sit now is nearly at that low level, which is good because we really want to see this 2.18 get to somewhere around 1.6, which is around where we actually expect the Federal Reserve to cut. So think about that for a moment. If we could get this 2.18 down to 1.6, then the Federal Reserve might actually cut. These are the two charts they're really using to drive everything. Now, of course, the banking crisis is driving these two charts. It's driving inflation expectations to come down because markets are starting to expect that a recession is more likely to occur, especially because of the banking crisis now. More banking crisis, tighter lending standards, which means more likelihood of, or a greater likelihood of recession. Now, what about this Credit Suisse debacle that happened? Well, let's just say if you want to learn how to lose 80% fast, the Saudis can teach you exactly what to do. Now, even though they say, don't worry, we're fine, this is not a good look for the Saudi private investment fund or the, quite frankly, the Saudi National Bank, not the private investment fund. It's the Saudi National Bank. A little different. The Saudi National Bank took a $1.5 billion stake in Credit Suisse in November. They bought those shares for $3.82. Actually, that's 382 francs. Let me be clear with that. Dollars slightly higher, add about 5% to convert to dollars. Anyway, those are now only worth 76 francs per share, or 76 cent francs. 0.76 francs per share. Here we go. That's how to say it. That's an 80% loss in less than 5 months as UBS is acquiring Credit Suisse for a bargain. The entire 166-year history for Credit Suisse comes to an end with this. And what's actually remarkable is even though there's an 80% loss for someone like or an institution like the Saudi National Bank in this Credit Suisse acquisition, what's actually even more wild is the fact that usually equity gets written to zero before you actually start seeing bondholders, which are generally deemed to be senior debt holders, get completely written off. But that's not what happened with the bail-inable bonds. We talked about these a few days ago, so we'll keep that discussion on these short since they're a little complicated. But there are these fancy things called AT1 bonds. They're nicknamed bonds with a grenade attached to them. I know that doesn't really roll off the tongue, but that's kind of what people call them because they're really high yield, but they're also potentially explosive. Now, we just had an about $17.3 billion write-down of those. In other words, these bail-inable bonds were written down from having a value of somewhere around, when we last talked about this on Thursday, 66 cents for each dollar of bond that existed, to zero. So in other words, they were written off completely as worthless. That's 12 times larger than any other bail-inable bond extinction ever. So oopsie doopsie. Nobody was really expecting that these would get written to zero and equity holders would still be held up. Now, there was a lot of talk that these AT1s were going to get written down. That's why we covered them last week. However, usually you have to respect capital structures and seniority on cap tables. So basically, if there's a preferred bond or an AT1, usually those are supposed to see liquidation profits before equity, like the shares. But that's not what happened here. And when the institutions were asked about this by Bloomberg, apparently there was a big pause. And everybody's kind of like you could almost hear sort of like a gasp in the room. And the response apparently from regulators are, "This is just the way we do it." Yeah, so I guess that sets a little bit of a new standard for the way people lose money in Europe. This is why, by the way, like long and short out of all of this, because let's talk more about implications on how that affects us. Long and short out of all of that, it's one of the reasons why I don't like investing in foreign countries, because they do stuff like that. That isn't, dare I say, normal. Like, I don't know what Chinese regulators are going to do or European regulators. At least I know and can take comfort in the fact that our regulators in America are incompetent and basically can't get anything done most of the time because it's too bureaucratic. But in general, we tend to like have a respect for at least things like that, the seniority of the way that you are supposed to lose money. But anyway, it's kind of, I guess, the beast that you grow up with and get familiar with that you end up being most comfortable around. I don't know. Some people call that a home bias. I just call it, I get the American way a little bit more, even though I was born in Germany. But that's not Swiss either. Anyway, all right, so people were hoping that this was going to contain some of the recessionary drama and panic and fear that's been circulating. Well, apparently it's not really helping, especially since you're still seeing a run on regional bank stocks. For example, look at First Republic Bank. Oh no, it's down another nearly 17% in pre-market. Here's Credit Suisse down about 57% in pre-market. That makes sense because that's about where it's being acquired. The acquisition price you would have to convert this is, again, 0.76 francs. 0.76 francs to USD works out to about 82 cents per share. It's actually trading at about 86 right now, so a little bit of a dislocation there in the pre-market. Then we've got UBS. UBS is actually up 1% in the pre-market. This has been pretty volatile, though. UBS about an hour ago was down about 6% in pre-market. So the market's still trying to digest exactly what's going on. What you do have to keep in mind, though, is UBS, it sounds at least like, is getting a pretty banger deal. So listen to this. They wrote the deal expecting to take $9 billion in losses. Now, that sounds crazy. Like, why would you buy a deal expecting to take $9 billion in losses, potentially up to those sort of losses? Well, in my opinion, it's the same reason you would buy a fixer-upper house, except there's a beautiful government guarantee that makes this even more beautiful for them. Listen to this. Imagine you buy a fixer-upper house, like I teach in the Zero to Millionaire Real Estate Investing course, right? You buy a fixer-upper house for $400,000 in a $600,000 neighborhood, and you're like, I'm comfortable putting in $50K of work. Okay, well, what if there's another $200,000 of foundation work that you just weren't aware of, right? That would suck. But because the deal is having to progress so quickly to prevent financial contagion in the entire banking sector from freaking out even more, the Swiss government is saying, don't worry if you lose any more than that 50K, in their numbers, $9 billion, we will cover you on your next $15 billion in losses. So in other words, yes, UBS is technically picking up a toxic asset, but they're doing so knowing that they're taking a write-down of up to $9 billion, but that's already built into their purchase price. They know that. And then for the next $15 billion in losses, they Gucci. The government is picking up that tab. Which means, yes, the taxpayers over in Europe are picking up that tab, potentially. So now they can argue, oh, right now taxpayers aren't paying for anything. Yeah, right. That's what they always want to do. They always want to dress it up as, no, don't worry, we didn't spend any tax money today. But for tomorrow, we may have just signed up for a lot of potential losses. Anyway, so that's how this is working with UBS, which is actually really interesting because if you think about it, it's probably a very opportune time to make these sort of banking acquisitions. And think about it. A bank is about to go bankrupt, and regulators are freaking out, much like with First Republic Bank. The FDIC couldn't find a buyer at their first auction. Now they're running a second auction. Bids are due Friday, by the way, in case you want to put some bids in on a $1 billion bank. Bids are due Friday. But anyway, the FDIC is frantically looking for a buyer for this. It's actually right about $4 billion right now. And they're hoping that they can close that sale quickly. Same thing that happened with Credit Suisse, because they want to minimize contagion. The longer it takes, the more a signal is sent to markets that these banks are extremely toxic. And the more the regulators have to sweeten the pie. I mean, look at how much they had to sweeten the pie with UBS. Well, same thing here with probably First Republic. Unless it's a really sweet deal, why would any private institution go for it? The people who have to make up the deal to actually make the numbers make sense are probably going to be taxpayers via the regulators. Anyway, this is really important because it could affect how deep of a recession we go into. And of course, Mike Wilson over at Morgan Stanley, being the bear that he is, and that's okay. It's okay to be a bear. We could still like you. Anyway, being the bear that he is, he's very unhappy about this banking crisis, and he's screaming that this banking crisis is really going to be exactly what we need to accelerate the R word, the recession. Now, he starts off by trying, in his latest piece here, he starts out by trying to make this argument that this is not quantitative easing. And we've talked about this many times before, but in short, the idea is that quantitative easing is a process by which we permanently expand the money supply, whereas what's happening now is many central banks are providing liquidity via loans. In other words, it's technically supposed to be paid back, but the reason it feels like QE right now is because, and I wrote this little note on the side over here, is because technically what you're doing is when you digitally print, let's do it like this, there we go. When you digitally print money, remember the Fed digitally prints, the Treasury physically prints. Anyway, when the Fed digitally prints money and then they transfer a loan to a bank or an institution, they're really providing the ability for that bank or institution to provide cash to depositors. That temporarily has the effect of increasing the money supply until that money is paid back, and then the money supply in theory would come back down. So really what you have is, it's technically not QE, it's technically a transitory expansion of the money supply. Yeah. So in other words, yes, in the short term, there is some money printing that does end up flowing through. However, there is this potential that the velocity of money actually goes down. When the velocity of money goes down and people are fearful and they invest less, they buy homes less, they buy less cars, they take out less debt, well, then you could walk into a recessionary environment. And this is where Morgan Stanley's Mike Wilson suggests the pushback we have been receiving for our basically bearish complaining has consistently been that the hard data has been holding up and companies are not seeing the slowdown that's being forecast. However, now we have the elusive catalyst that should lead to the convergence of hard and soft data. In other words, basically what they're saying is, hey, we think this banking crisis is finally going to lead to that earnings recession that we've been talking about. The reason we believe that is because lending standards are going to tighten, and that increases the risk of an actual credit crunch. And that does not bode well for growth. See, usually when credit standards tighten, like right here, we could see the blue line. This is an inverted curve. So the tighter things go, instead of being up, the chart is down. And they do that so they can align it with GDP to show when GDP goes down. So they invert bank tightening. But basically, the lower the blue line goes, the tighter lending is. And you could pretty much see in this chart that goes back to the early 90s that every time the blue line goes down, the yellow line comes down with it. That's real GDP. Now, one of the downsides, in my opinion, of using real GDP in this analysis is we are in a high inflationary environment. So we could actually be at a, let's say, 1% GDP next year. We could have a growth rate of 0.5 or 1% or whatever. And usually GDP is inflation adjusted, okay, worth noting. But the point is, you could actually have nominal growth, but because we're in such a higher inflationary environment right now compared to what we've seen at any point in time in this chart, notice how the 70s and 80s aren't included here, maybe that, quote unquote, this time could be different, which is a dangerous thing to say, we know that, but of course, it's just something to consider. But anyway, their argument is here, generally, the yield curve steepening is the painful period of time. And it's true. Usually stuff breaks and the yield curve steepens. And that's basically what we're seeing right now. When you look at the 2s, 10s, you can see that the spread has actually narrowed. That's called a steepening. And it's not the inversion of the yield curve that's generally painful. It's the subsequent re-steepening. And that's because everybody starts panicking, stuff gets broken, all the fine china falls off the shelves, everybody loses their poopsie doopsies and stops spending money, and then you actually end up in a recession. This is the 210s curve, by the way, right now. And you could see how inverted we got just walking into the banking crisis. Ridiculously inverted. And now you're seeing this sort of steepening. And it's that subsequent up that tends to be very painful. So that does actually reiterate historically what Mike Wilson argues here. So, but of course, stocks barely moved last week. In some cases, they actually rallied last week. And Mike Wilson argues that this is because we've now, quote, reliquefied the banking system. And that money is going to flow into the economy for a brief period of time. But that's not going to matter because soon enough, that is going to lead to the realization that, wait, now the banks have more debt, not more free money, and that's going to make their leverage ratios lead to even tighter lending standards, and then earnings basically come down. Mike Wilson's biggest argument is that earnings aren't going to hold up at the S&P 500. And he says that over and over and over again. But it's just really entertaining to see him lash out because he's always lashing out, and maybe he'll end up being right. But he's always lashing out because it seems like the more he lashes out, the more the market doesn't actually fall. Since obviously I tend to take the bullish position, at least at this phase in the cycle, I'm taking the bullish position. I flip-flop a lot, though. Remember, you can always follow every one of my flip-flops by subscribing to the channel or using that coupon code that expires in 2 days for the St. Paddy's Week sale. But anyway, look. I mean, this is your QQQ, right? We broke the massive downtrend. We regularly bounce off the 200-day moving average. From a fib support line, if we break 311 right here after this next FOMC meeting, that is, let's say we get our 25 BP that we're expecting, and then J-Pow comes out and he's a little bird pecking on the floor like a dove, and he's super sad or like concerned, risk assets will probably rally. I mean, we're already seeing that in Bitcoin, but we'll talk about that in a little bit. But you don't actually see, despite all this banking madness, any real pain, at least not in the NASDAQ over here. And that could be because so many people are just sitting this out on the sidelines, which is fantastic for the people who are actually in the market. And then here's your SPY. Even the SPY's holding up pretty decently. So somewhat remarkable that you're seeing this sort of behavior in markets, while at the same time you're having such a crisis in the banking sector. Now, as all of this is happening, I thought this was a little bit mind-blowing, but as all of this is happening, Credit Suisse apparently addressed concerns their staff have and are now saying, quote, "There are no changes to payroll. We will pay salary and bonuses where outstanding as previously communicated. Employee salaries and any bonuses that are due will still be paid on March 24th, per the memo." Well, that's 2 days after the expiration of the coupon codes. Well, if you work for Credit Suisse and you need an extra couple days to get your final pay and then join the courses, just email me at kevin@meetkevin.com. But otherwise, price go up. 22nd, end of the day, 11:59, California time. So there's the latest on the banking crisis. It's worth noting what we'd heard about yesterday with the Fed. You watched that video. Obviously, that was a big deal, seeing the Fed come out on a Sunday to provide more liquidity. Don't kid yourself. It is a temporary, I'm calling it transitory QE. That's what it is. It's transitory money printing. And I'm sure because it's transitory, it'll almost certainly be permanent.